Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Welcome back to the Grow Your Wealthy Mindset podcast. Today, I'm going to talk about capital gains tax. I know taxes is not everyone's favorite subject, but I do think it is something that we need to know about so that we can pay less of it. The tax code is really a complex collection of incentives to encourage individuals and corporations to do things that the government wants us to do. Believe it or not, the government does want people to invest. One incentive towards this goal is that some investment income is taxed at a different rate from the rate of ordinary income taxes. There are many specific tax advantages that come from real estate investing, but there is one tax that covers a wide range of investments, including real estate, which is the capital gains tax. A capital gain refers to profit realized when an asset is sold for a higher price than its original purchase price. When you hold an asset that gains in value, your net worth may increase, but you have yet to realize that profit. Once you sell the asset, that's when you lock in the profit. This is also true with losses. For example, if you buy shares of an index fund, the value of those shares can go up and down. We know the stock market can be volatile. When you log into your brokerage account, you may see that you, quote, lost money if the share values went down since the time that you purchased the shares. But you haven't actually lost that money until you sell those shares. Once you sell the shares, that's when you lock in either your profit or your loss, depending on the price that you paid for those shares when you purchased them. The capital gain or loss is calculated by the sales price or proceeds from selling the asset minus the purchase price or the cost basis of the asset. Capital gains can occur with various types of assets, including stocks, bonds, real estate, and valuable items like art or collectibles. If you bought shares in a particular stock 2 years ago at $50 a share, and now it's worth $70 a share, your capital gains, if you sold that stock, is now $20 a share. These gains are typically subject to federal tax and may be subject to state or local taxes depending on where you live. If the asset is held for over a year, then the federal taxation rate is the long-term capital gains rate, which is lower than the regular income tax rates, which is how short-term capital gains are taxed. Someone who's doing day trading with the stock market, they'll end up paying short-term capital gains on those day trades. Like ordinary income taxes, there are different tax brackets for long-term capital gains tax. The brackets are much less than with ordinary income. If you are single with a taxable income less than $44,625 in 2024, or married filing jointly with taxable income less than $89,250, again in 2024, then the long-term capital gain tax is zero. You don't actually have to pay any taxes on your long-term investments. While physicians are unlikely to fall in this tax bracket during their working years, it can be possible to engineer being in this tax bracket range during your retirement years. I'll talk a little bit more on that later. Many of us will fall in the 15% tax bracket for capital gains tax, which is from $44,626 to $492,300 for single filers, and $89,251 to $553,850 for those married filing jointly in 2024. If you are single with taxable income of over $492,300, or married filing jointly with taxable income over $553,850, then you'll end up paying 20% in capital gains tax. Long-term capital gains tax is less than ordinary income tax for any given tax bracket or income level. Short-term capital gains falls in the category of ordinary income and is taxed at that ordinary income tax rate. Remember, your ordinary income is taxed at a marginal rate for individuals. If you sell an asset 364 days from the time you acquired it, you would pay your marginal rate, or the percentage of your tax bracket, on the profit from that asset. If you wait another few days, you would pay the capital gains rate. Whenever possible, hold onto your assets for longer than a year before selling. If you're flipping a piece of real estate, meaning you're buying a property, maybe fixing it up, and then selling it at a profit, then make the calculations. Depending on your profit and the holding cost, it may be worthwhile to wait to sell until a year after you purchase the property. You could also consider renting out the property prior to selling it in order to get some income from it while you're holding it for that 1-year time period. Long-term capital gains tax applies to businesses as well as an individual. Income generated by a business from the sale of long-term capital assets, such as land or equipment, would be subject to the lower capital gains tax rate. The nice thing about capital gains is that generally, we choose when we sell the asset, and therefore we can choose to sell assets that have significantly appreciated in years where our taxable income is lower. If your household income is near the cutoff between the 15 and 20% tax rates, you may want to time the selling of assets during years when you would fall in the 15% bracket. You may also want to consider whether you could lump tax deductions in 1 year to bring you under that threshold. This probably becomes more applicable when you start to liquidate your portfolio for cash flow once you stop working for income. You may want to liquidate more of your portfolio every other year so that you may be able to fall in the 0% tax bracket for some years and the 15% tax bracket for other years. During 1 year, you could sell off part of your portfolio for cash to live on throughout that year, and then in December, sell off enough to fund most of the following year. Then the following year, do the math and keep the level of your income, including selling off assets, to stay under the threshold for paying 0% capital gains tax. There are some other caveats worth mentioning. Long-term capital gains tax on so-called collectible assets can be taxed at a maximum of 28% instead of 15 or 20%. The Taxpayer Relief Act of 1997, which lowered the maximum capital gains rate on gains from the sale of most assets to 20%, left the maximum rate on gains from the sale of collectibles at 28%. Collectibles include items such as fine art, rugs, stamps and coins, precious metals and gems, antiques and historical objects, as well as fine art. Short-term capital gains on such assets are taxed at the ordinary income tax rate. There is a clause that any tangible personal property specified by the Treasury could be a collectible. So think of any object that you could keep inside your house as possibly being classified as a collectible. Capital gains tax does not apply to selling investments in tax-advantaged accounts, like your 401k, 403b, IRA, etc., whether it's the traditional version or the Roth version. With traditional retirement accounts, you'll pay ordinary income taxes on any money withdrawn from the account, plus any penalty depending on the circumstances around the withdrawal. However, if you're selling assets within the account and not withdrawing, but just reinvesting it into some other asset, then you're not going to be paying any capital gains, even though you're selling assets. That's the point of a tax-advantaged account. It doesn't have to actually pay any taxes for any activity that happens within the account. With Roth accounts, as long as you follow the rules, you can withdraw the money tax-free. And that's why I love Roth accounts. When it comes to selling your primary residence, you likely won't have to pay capital gains tax as long as you lived in the property for 2 of the last 5 years. The property has to have been your main residence, not a second home or a vacation home. And you can't have claimed the home sales exclusion in the previous 2-year period before the home sale. If you meet the requirements for the home sales exclusion, then you don't have to pay any taxes on the first $250,000 of gains if you're single, or $500,000 of gains if you're married filing jointly. This means that you could live in your home for 2 years, rent it out for, let's say, 2 years, and then as long as you sell it within 3 years of when you moved out and didn't use the exclusion on another property, you would be able to enjoy 6-figure profits tax-free. Of course, depending on how much you make on your home, it is still possible you would have to pay taxes. So if you're married filing jointly and you make $600,000 on the sale of your home, then you would have to pay taxes on that $100,000, that $600,000 minus $500,000. That's why it's important to keep track of all the repairs and improvements you've made on your property while you're living there. Some of those costs can actually be deducted so that if you're above the home exclusion amount, you can deduct those expenses and still stay within the home exclusion amount. There is another tax to be aware of when you are selling assets for a profit. and that's the net investment income tax, or NIIT. This is an additional 3.8% tax that can be triggered if your modified adjusted gross income exceeds $200,000 for individuals and $250,000 for married filing jointly. This tax came into effect on January 1st, 2013, and affects income tax returns of individuals, estates, and trusts. Figuring out your modified gross income for the net investment income tax is a bit complicated. In terms of the tax code, the modified adjusted gross income is adjusted gross income, which you can find on Form 1040, line 37, when you file your taxes, increased by the difference between amounts excluded from the gross income under Section 911A1 and the amount of any deductions taken into account in computing adjusted gross income or exclusions disallowed under Section 911D6 for amounts described in Section 911A1. To put that a little bit more simply, your gross income is all your income from wages, earnings, capital gains, rental income, royalties, and even Social Security payments or unemployment benefits. Your adjusted gross income is your gross income minus specific deductions that include things like IRA contributions, self-employment, retirement plan contributions, health savings accounts deductions, student loan interest, tuition and fees, etc. Your modified adjusted gross income, or MAGI, M-A-G-I, is your adjusted gross income, your AGI, with certain deductions added back in. So not all deductions, but specific deductions. These deductions include, but are not limited to, your IRA deductions, student loan interest, half of self-employment tax paid, qualified tuition expenses, tuition and fees deductions, passive loss or income, non-taxable Social Security payments, exclusion for income from U.S. savings bonds, foreign earned income exclusion, foreign housing exclusion or deduction, the exclusion for adoption expenses, rental losses, and publicly traded partnership losses. Unfortunately, many physicians will have to pay the net investment income tax on their investment income. Taxes is generally not a fun topic, but it is important to understand our tax system to try to legally minimize how much we pay in taxes. Knowledge is power, but you have to take action to get results. Of course, I am not a CPA, so please talk to your CPA or tax advisor when it comes to filing your taxes. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you've been learning a lot by listening to this podcast, please consider sharing the podcast with others. Help me reach as many physicians or high-income professionals as possible so that we can all increase our financial literacy, build wealth, and become financially free. Have a great week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.